You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. We are in the heart of earnings season. Last week on Options Playbook Radio, we looked at getting bearish on Apple. We hadn't been bearish on a trade in quite some time. Apple was announcing earnings. We tried to manage our risk by doing a bear put spread. We put the put spread together. It was 7.5 points wide, and we made sure that we had more upside than downside. So we paid, I think, $2.80 approximately for that 7.5 point wide spread. Maximum it could trade for was that 7.5 points. We were well within the expected move, but Apple came out with earnings and the stock actually went up. And to be blunt about it, it actually brought the whole market up overall. So you could say that it was just Apple, but in general, there were a lot of other companies that were announcing earnings on the same day. But it kind of it brought the VIX came down a little bit after they announced. The market in general just had a couple of strong up days after Apple, meaning to say we did a very short term bearish trade on Apple, and we needed the market to open down after earnings, and it did not. So we managed our risk, but that $2.80, there really wouldn't have been much you could have done with it. You might have been able to sell out right away because Apple didn't blow the market out of the water, right? It just moved approximately the expected move, which was only about 4 or 5%. And you could have maybe closed it out and tried to salvage it. I personally would have just wrote it to see if Apple turned around. You only had 2 days worth of trading before those option contracts expired. So let's go look at another earnings trade. Google announced earnings today, and I should let you know that we are taping on February 2nd. It's a Wednesday. The markets are closed. They announced earnings after the close yesterday, and they had a solid earnings report, but they also announced that they're going to do a 20-for-1 stock split. Now, that drove the stock to the moon, basically, if there is such a thing. The day's range in Google was from 2009-11 all the way up to 3041, which is an all-time high in Google. It ended up closing at 2009-60, up 203 points on the day. The expected move was around 155. So it definitely moved more than expected, and that mainly came because of the stock split announcement. And I always find it interesting that companies decide on a very volatile day to even add more volatility. And when they are doing stock splits, they usually choose to do them or announce them after an earnings report, which I really don't quite understand. All right. So people have been whispering about Amazon having a stock split, which I kind of expected Amazon to do it before Google. But you understand why people would like to, or why companies do stock splits, especially after the big move up today. Nothing fundamentally changes with the company, but it makes it easier to buy a round lot, 100 shares of it at a much lower price. As a matter of fact, with Google, if you looked at the stock split, if the stock stayed somewhere around here, you're looking at a stock price of around $135 to $140. And for every share of Google that you would own, you would get 19 additional shares. So they have the weird Class A, Class B, Class C thing going on with Google. So there's be more to come with that as to exactly how it is going to be determined when it's all said and done. Okay. So Google goes up 200 points, blows away the expected move. We're going to look at Amazon. A lot of times we've looked at skip strike trades where you have more risk, but you're getting them done for a net credit, and you can go way out of the money. As a matter of fact, on Tuesday, I talked about a skip strike butterfly in Google that was about 170 points out of the money. If you'd like to review it, it is on the Ally YouTube channel. This Friday, we'll be talking about it and talk about how we would have adjusted the trade. Because obviously, if you didn't stick around and you just got out right on the open with Google, that trade was not profitable. Because it did have a big gap open. As a matter of fact, the highs on Google were most of the time in the morning where it stayed up above that 3,000 level, but 100-point range basically in the stock today. So the stock was all over the place. So with Amazon, we have the same scenario going on. We have a very expensive stock. Amazon closed the day at $3,012.25. We have an earnings report, pumped up implied volatility. And the most interesting thing to me about Amazon is that they always announced earnings. For many, many years, for as far back as I can remember, they've always announced earnings on a Thursday after the close. That means that you have all this juice in these option contracts. And if you do the Friday expiration, those option contracts have 1 day to live. So they're going to expire on the close on that Friday. So all that juice has to come out of those option contracts, which makes it interesting to do speculative trades in Amazon around earnings. So with that said, we're going to take the lesson from Google, and we're not going to look at a skip strike butterfly. We're going to just look at a standard butterfly. But guess what? We can go 50 points wide, which is going to give us almost a 100-point landing area for Amazon after earnings. We're going to go big. We're going to go more than the expected move because this is such a speculative trade. We don't want to pay a lot for this butterfly. So we're going to go further out of the money. We're going to hope that we can pick a 100-point landing spot. But bottom line is we need to have a good earnings report because we're going to use call options. And not only do we need a good earnings report, we need it to move more than what the marketplace is implying, more than what the expected move is. So let's go and look at the Amazon option chains inside the Ally Invest live trading platform. And if we see the cost of this butterfly, even though it's 50 points wide, I haven't given you the exact numbers yet, but the cost is going to be $1.65 for every 1x2x1 butterfly. That's $165 plus commission. That's going to be your total risk of the trade. So I always like to just pop in and look at Amazon and say to myself, okay, Amazon is the most at the money strike is the 3,010 strike. How far out of the money on the call side do I have to go to get to a call option that is trading on the ask for $1.65? And in order to do that, which would be the cost of the butterfly, I have to go all the way up to almost the 3,700 strike. to get to an option contract that is trading for, on the ask, $1.62. The exact strike is 3,690. The 3,690 strike call option is trading 116 by 162 at 120% implied volatility. So rounding off, you're looking at about, if you're going to buy that option contract, you're basically saying you think that Amazon's going to move 700 points. And I just can't fathom that option contract is trading for that dollar amount overall. Very low probability of it ever getting to that price, but that's the premium that you have to pay to play in Amazon around earnings. So how do we get that down in price? So I picked $1.65 because that's the price of the butterfly. To start with, to set up the butterfly, we want to make sure that it's feasible for the underlying stock to get to that strike. So we're going to start by looking at the 3010 strike long straddle, which gives us the expected move. If I round off a little bit, because we've got a little bit wide markets right now with the markets being closed, and we're talking about about 180 points overall. So if you take 3010 and you add 180 to it, that means that the marketplace is saying if it had a good earnings report, that a potential move would, or the line in the sand, the over under, if you want to do it that way, would be 3,190. Now, the expected move never has any regard to direction. They're just saying that this is what people are willing to pay for the straddle. So the marketplace thinks of that as, well, that's a potential move before that Friday expiration overall. So we're going to go a little bit further out of the money because it is such a speculative trade and we want to manage our risk. We don't want to spend a lot on this. So $165 for every 1 by 2 by 1 butterfly. That isn't a lot. And you've got to be prepared to lose that if you do this. And as always, these are meant to be paper trades. This is a very speculative trade around earnings on Amazon. So I always have to emphasize that. And now I'm just going to use nice round numbers just to make it simple because it is a podcast. So we're going to go a little bit further out of the money from the 1,190 that we were targeting. We're going to use the first call option that we're going to be buying in our butterfly is the 3,250 strike. We're then going to sell the 3,300 strike, and then we're going to buy the 3,350 strike. If we look at that and we do a 1 by 2 by 1 butterfly, we can get that trade done for about 160. All right, just a little bit less than what we were looking at on that long call option. So the midpoint with the markets fairly wide is about 160 on that trade. That means our maximum risk is $160. The width of the butterfly is 50 points. So that means that there's about a 100-point landing space for the butterfly by that Friday expiration. Maximum upside would be that 50 minus that $1.60 in the account. And obviously you're not looking to get 50 points on this butterfly. That means that it would stop right at the 3,300 strike. But the maximum upside of the trade, which we do have to mention, is $4,840 or $4,840 overall. All right. So that's going to be, it's amazing that we can go 100 points wide, have a 100-point wide landing area, basically on this butterfly, get it done for about $1.60. The option contracts overall, the most at-the-money option contract in Amazon is about 95% right now. And we're not going to do the skip strike because we can get this done for a fairly decent price. So we don't want to add in that additional risk overall. And to be blunt, Google scared us a little bit with what actually happened today in that underlying stock and it blowing away the expected move overall. All right. So do a quick little recap here. We're looking at Amazon. They're going to be announcing earnings tomorrow after the close, which I would set this trade up a little bit closer to the close. But based off of where the prices are at right now, we saw Amazon close at $3,012.25. We're going to go on the call side. We're going to buy the 3,250 strike call with the most near-term expiration, which is February 4th. Then we're going to go and sell 2 of the 3,300 strike calls, and then buy 1 of the 3,350 strike calls. Right now, that butterfly is trading for a net debit of $160 or $160 plus commission for every 1 by 2 by 1 butterfly that is placed. Whew. All right. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. Please follow me on Twitter. The handle is very simple. It's at Brian Overby. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.